In the United States, nearly 400 million acres of farmland are expected to change hands over the next 2 decades. To put that scale into perspective, that is a landmass larger than California, Texas, and Montana combined. It is the greatest transfer of agricultural real estate in human history. Whoever buys that land will control one of the most important assets in the American economy. Not oil, not technology, not real estate. Food. Most Americans assume they know what happens next. They assume the next generation of farmers will buy it. They assume families will take out loans, plant the fields, and build equity in the soil. The public records suggest something else. If you pull the property deeds in rural counties today, you will not find the names of local families. You will find strings of letters, limited liability companies, Delaware registrations, asset management firms, real estate investment trusts, pension funds. Americans work the land, but increasingly they do not own it. What is happening beneath the soil of the American heartland is a quiet, systematic acquisition by entities that do not plant, do not harvest, and do not live in the communities they buy into. Most people think they are witnessing the end of the family farm, but what they are actually witnessing is the financialization of the earth. When the subject of farmland ownership is raised, one name usually dominates the conversation. Bill Gates. Public records reveal that Cascade Investment, the holding company managing the wealth of the Microsoft co-founder, has acquired roughly 275,000 acres of farmland across more than a dozen states. The revelation shocked the public. Why would a tech billionaire quietly buy up hundreds of thousands of acres of dirt? Theories flooded the internet. Some assumed it was a philanthropic experiment. Others speculated it was an attempt to control the food supply. But if you look at the transactions, the legal structures and the financial filings, a much clearer and much colder reality emerges. Bill Gates is not the story. He is a symptom. He is simply the most visible participant in a massive systemic shift in how capital views the physical world. He did not invent this strategy. He merely executed it at scale. To understand what is actually happening, we must stop looking at the billionaires. We must look at the asset managers, the public markets, and the institutional funds holding trillions of dollars in wealth. And we must ask the central question: why do the wealthiest entities on earth suddenly want dirt? The answer lies in macroeconomics. In the boardrooms of global finance, capital is constantly searching for safety and yield. Oil can be depleted, companies can fail, currencies can collapse, paper wealth can vanish in a single afternoon of algorithmic trading. But there is one asset every human being depends on every day: land. For over a century, farmland was viewed as a local, illiquid market. It required specialized knowledge and heavy machinery. Wall Street had little interest in the slow business of growing crops. Then the math changed. Institutional capital realized that farmland possesses a unique combination of traits that make it the ultimate financial safe haven. First, it is an inflation hedge. When the cost of living rises, the cost of food rises. When the cost of food rises, the value of the land that produces it increases. Unlike a bond, which loses purchasing power during inflation, farmland absorbs inflation and converts it into profit. Second, population growth guarantees demand. The global population is expanding. While the amount of arable land is strictly finite, they are not making any more soil. In fact, due to urban sprawl and degradation, the supply of farmable land is shrinking. Economics dictates that when demand is guaranteed and supply is finite, value moves in only one direction. Third, water access. When an investor buys a farm in regions with deep aquifers or established water rights, they are not just buying dirt, they are buying legal access to the most critical resource of the 21st century. When you combine inflation protection, guaranteed biological demand, finite supply, and water security, farmland ceases to be just an agricultural tool. It becomes a Tier 1 financial asset. this transition did not happen overnight. The financial takeover of American agriculture required a catalyst, a moment when the old system broke, leaving the door open for institutional capital. That moment was the 1980s farm crisis. Before the 1980s, the barrier to entry in farming was manageable. But to combat runaway inflation, the Federal Reserve spiked interest rates to historic highs. At the same time, a Soviet grain embargo caused commodity prices to collapse. The result was an economic slaughter. Over-leveraged farmers could not make their loan payments. Between 1978 and 1991, nearly 300,000 farms failed. Foreclosures swept across the Midwest. Local banks collapsed under the weight of toxic agricultural debt. In the aftermath of the crisis, the American agricultural landscape was consolidated. Mid-sized farms were absorbed into massive industrialized operations. The financial barrier to entry permanently shifted. Decades later, during the 2008 financial crisis, institutional investors remembered the lessons of the 1980s. When the stock market fractured, asset managers realized they needed to park billions of dollars in tangible assets. They looked at the consolidated American countryside, and quietly, the corporate acquisitions began. So, if the landscape was cleared for institutional capital, who actually stepped in to buy it? Look at the public records. Consider TIA, the Teachers Insurance and Annuity Association of America. It is a massive pension fund that manages retirement accounts for academic and medical professionals. Through its asset management wing, Nuveen, TIAA manages approximately 2 million acres of farmland globally. They are one of the most powerful institutional landowners in the world. Then there is the Real Estate Investment Trust, or REIT. Firms like Farmland Partners Inc. and Gladstone Land Corporation are publicly traded companies. They operate under a specific legal and tax structure designed to pull capital from investors, acquire agricultural real estate, and distribute the income as dividends. But REITs require massive amounts of capital to scale. If you look at the major institutional shareholders of these publicly traded farming trusts, you will find the largest asset managers on earth. Firms like BlackRock and Vanguard. They do not buy the farms directly, they buy the financial instruments that buy the farms. This structure creates a pipeline that funnels passive Wall Street capital directly into rural American soil. These actors do not operate tractors, they are fiduciaries. Their legal obligation is to maximize risk-adjusted returns for their shareholders. They view a 1,000-acre farm in Nebraska exactly the same way they view a commercial skyscraper in Manhattan. It is a portfolio allocation. When capital of this magnitude enters a finite local market, the fundamental nature of the market breaks. A young farmer cannot walk into a local bank and secure a loan to buy land at peak Wall Street valuations, but an institutional fund can write the check in cash. How does a Wall Street fund manage a farm without ever touching a plow? The mechanism relies on a structure known as the sale-leaseback, combined with the standard cash rent model. An investment fund identifies a prime parcel of agricultural land using sophisticated data analytics. They make an all-cash offer that mathematically outbids local buyers. Once the fund acquires the deed, they do not hire employees to farm it. Instead, they lease the land back to a local farmer. This creates a split incentive. The operator, the local farmer, is responsible for purchasing the $500,000 machinery, buying the seeds, acquiring the fertilizer, and performing the grueling physical labor. The landowner simply collects the rent, and that rent is often paid up front, in cash, before a single seed is planted. But the system is accelerated by something far more powerful than rent, the tax code. When investors sell commercial real estate at a profit, they are normally required to pay capital gains taxes. However, Section 1031 of the Internal Revenue Code allows investors to defer those taxes indefinitely if they reinvest the proceeds into a like-kind asset. A hedge fund can sell an office building in San Francisco, realize a massive profit, and roll that money directly into thousands of acres of Idaho farmland without paying immediate capital gains tax. The tax code effectively subsidizes the transfer of urban commercial wealth into rural agricultural land. The local farmer must make the math work based on what the crops will yield. The institutional buyer only needs the math to work based on their portfolio's target return rate and tax advantages. The result is mathematical certainty. The price of soil rises, driven by financial engineering rather than farming fundamentals. To truly understand a system, you must follow the money. Who absorbs the risk and who captures the profit? In the spring, the tenant farmer takes out an operating loan from a local bank. The farmer uses this borrowed money to pay the institutional landowner their cash rent. The money moves from the rural bank through the farmer into the account of the LLC and is distributed as a dividend to shareholders in New York, Chicago, or beyond. If there is a drought, the farmer's yield drops. If there is a trade war, commodity prices collapse. The farmer absorbs the total volatility of the agricultural market. The institutional landowner, however, has already been paid. Their return was secured before the season began. The risk has been entirely decentralized onto the tenant. The profit has been centralized into the fund. But there is a secondary flow of money that guarantees this system: the United States government. Agriculture is one of the most heavily subsidized industries in America. Through the USDA, billions of dollars are distributed annually. On paper, federally. Subsidized crop insurance and direct payments are designed to keep the American farmer afloat. But economics dictates a different reality. When the government guarantees a baseline of revenue for a piece of land, the financial value of that land increases. Who captures that increased value? The entity that holds the deed. If federal crop insurance guarantees a certain revenue, institutional owners can safely raise the cash rent, knowing the farmer's floor is protected by the taxpayer. The federal subsidy, intended to support the rural worker, effectively becomes a pass-through mechanism. The taxpayer subsidizes the farmer pays the higher rent. The yield is captured by the asset manager. What is the cost of this system? If crops are still being grown, why does the ownership structure matter? The answer lies in the economic architecture of the American countryside. When a family owns their farm, the wealth generated by the soil remains in the community. The profits are spent at local businesses. The property taxes support local infrastructure. When land is owned by a distant financial institution, the model changes from wealth creation to wealth extraction. The harvest remains local. The ownership does not. The farmer still owns the tractor, but increasingly, someone else owns the ground beneath it. The wealth generated by the harvest is stripped from the rural county. Over time, the local economy hollows out. The Main Street businesses close because the tenant farmers operate on razor-thin margins and have no surplus capital to spend. This is not a failure of the market. It is the market functioning exactly as it is legally structured. Investment funds are executing their fiduciary duty. The tax code is operating exactly as written. The subsidies are flowing exactly where the incentives direct them. No laws are being broken, but a profound structural shift is taking place. Look at the fields as you drive across the country. The corn looks the same. The wheat sways exactly as it did 50 years ago. The physical reality of the landscape appears untouched, but the invisible architecture beneath the soil has been completely rewired, and a liquid physical asset has been transformed into a highly engineered financial instrument. The question is no longer whether American farmland is changing hands. The question is who will own it when the transfer is complete. Because whoever owns the land will not just influence agriculture. They will influence food, water, communities, and the future of rural America. This was never just about farmland, it was about ownership. If you found this investigation valuable, share this dossier. We invite you to examine the public records in your own county. Who holds the deeds in your state? Let us know what you find in the comments below. Next time, we will examine the financial structures quietly acquiring, single-family homes, and why the concept of the American starter home is disappearing into the portfolios of asset managers. You are watching Historic America. The truth is in the transactions. Follow the money.